All right, welcome to the Explainer. Today, we're digging into some really big new forces that are pushing inflation up. And at the same time, there's a political battle brewing that could completely change how your money is managed. We're talking economic headwinds, political storms, so let's just jump right in. Okay, let's tackle this question head on. Because honestly, the answer hits every single one of us right in the wallet. I mean, from your grocery bill to your 401k. For most of our lives, right, stable prices have just been normal. But the world is shifting, and the rules of the game, well, they might just be shifting right along with it. So to really get a handle on where we're headed, we've got to first look back at the, well, shockingly calm economic waters we've been sailing through for decades. Turns out the folks at the central banks had some serious help. And look, that's not to say their job was a walk in the park or anything, but it's so important to get this. It wasn't just some brilliant policy that kept prices in check. There were these massive global forces working in their favor, basically doing a lot of the heavy lifting for them. So, what were these forces? Well, according to some great research from the Brookings Institution, you can think of them as tailwinds. Picture it. First, you had globalization just exploding, flooding markets with cheaper goods. At the same time, this thing called the Washington Consensus, basically a worldwide playbook for free markets and keeping government spending tight, took over. And then the power of unions was declining, which meant less upward pressure on wages. You put all that together, you get this constant, powerful push downward on inflation. And the key takeaway here is that the Fed's ship had these amazing winds at its back. Because inflation was naturally being kept low, there just wasn't as much political temptation to do things like, print a bunch of money to juice the economy. It all made for some pretty smooth sailing and those stable prices we all just got used to. Okay, so let's fast forward to today, because this is where the story really gets interesting. Those nice, favorable winds, they haven't just calmed down. They've done a complete 180. The tailwinds are now headwinds, and that makes the Fed's job, well, infinitely harder. And you can see that flip so clearly. The age of what you might call hyperglobalization, that's giving way to slowbalization and even protectionism. That old focus on fiscal discipline, it's being swapped out for rising government debt. And that long decline in worker power, well, that might be starting to reverse course. The entire economic weather pattern has changed. And these specific headwinds are creating this new, constant upward push on prices. Just look at the numbers. Trade restrictions have just skyrocketed. Government spending is climbing for all sorts of reasons. And then there's this weird, kind of counterintuitive twist. For years, when interest rates were basically at zero, it was a signal to everyone that the economy was fragile, which actually helped keep inflation expectations low. But now that rates are high. And look, this isn't just some abstract economic theory. To put a real number on it, one model from Brookings suggests that even a moderate step back from globalization could jack up long-run inflation by 1.4%. I mean, think about that. That alone makes hitting that 2% target a massive challenge. So you have these powerful new economic headwinds, and now they're slamming right into a political storm. And the eye of that storm is focused on one of the most powerful economic institutions on the planet, the U.S. Federal Reserve, and specifically, who gets to run it. This right here just perfectly illustrates the tightrope the Fed is walking. I mean, on one side, you've got stubborn inflation that's screaming for tighter policy. Raise interest rates, cool things down. But on the other side, you've got a job market that's starting to look a little shaky, and that calls for the complete opposite. Cut rates, give the economy a boost. It's a classic catch-22, forcing the Fed to choose between its two main jobs. And that conflict comes straight from the Fed's dual mandate, which it gets from Congress. Its job is to keep prices stable and to keep employment as high as possible. For a long time, those two goals kind of moved in the same direction. But right now, they are pulling in completely opposite directions. And that forces a really tough trade-off. So this economic problem is about to get very political. Fed Chair Jerome Powell's term is up in May 2026, and the incoming administration has been very open about its plan to replace him and its desire for the Fed to push for lower interest rates. That really sets the stage for a major test of the Fed's independence. So, who's in the running for the top job? Well, according to analysts at firms like Stifel and BNP Paribas, these are the names to watch. You've got Kevin Hassett, who's widely seen as the loyalist frontrunner. Then there's an insider, Christopher Waller, who's already a Fed governor. And you have a couple of other folks with close ties or cabinet experience. The point is, each one of these candidates represents a very different direction for the future of Fed policy. So let's just be really direct about what the political goal is here. The idea is to get the Fed's monetary policy in line with the administration's agenda. And that means specifically pushing for lower interest rates. Why? Well, it makes the government's own debt cheaper and it helps stimulate the economy. The huge trillion-dollar question is whether you can do that and still stick to the Fed's main job of keeping prices stable. Okay, so all of this intense political pressure creates this really clear fork in the road. And there are two very different paths forward for the economy, for inflation, and at the end of the day, for your money. So this really lays out the two futures we're looking at. On one hand, you have the path of independence. That's where the Fed just keeps doing what it's always done. Follow the data, make tough, sometimes unpopular calls, and resist political pressure. Then you have the other path, alignment. That's where a new Fed chair might yield to that pressure, cutting rates to help a political agenda, even if the economic numbers don't really back it up. And I know this can all sound a little abstract, like something for economists to argue about. But why should you care? Because this isn't some ivory tower debate. The outcome here is going to hit you directly in your wallet. We're talking about the interest rate on your mortgage, the actual value of the cash in your savings account, and the health and stability of your 401k. And this gets to the ultimate danger. See, if the financial markets, the big players who lend money, start to believe the Fed isn't serious about fighting inflation anymore, they're going to protect themselves. They'll start demanding higher and higher interest rates on long-term loans. And that creates this vicious cycle. If inflation expectations get unanchored, then borrowing costs are going to shoot up for everybody, for mortgages, for car loans, for business investment, for government debt. It won't even matter what the Fed does with its main policy rate at that point. The damage could last for years. So here's where we land. That easy era of low inflation, the one we got used to thanks to decades of those helpful global tailwinds, it's over. And what's replaced it is a storm of inflationary headwinds and some really intense political pressure. The big question, the one that will decide the future of inflation and your money, is this. Is the Federal Reserve's independence strong enough to navigate that storm?